Hola, buenos días. We are just waiting for our members to join the conference. Okay, let's begin. Hola, buenos días. Good morning, everyone. On behalf of the U.S.-Mexico Chamber of Commerce, we would like to welcome all of you, members and friends. My name is Clementina Guy, and I'm the Executive Director of the Inter-American Chapter based here in Miami. I just want to share with everyone a few words before we start the conference. We cannot deny that we are experiencing difficult times, but it's also important to remember that we should try to stay positive and strong. We need to see this event as an opportunity to be a better version of ourselves, better fathers, mothers, neighbors, co-workers. Now more than ever, we need to be empathetic. We need to keep on smiling and be grateful of who we are and what we have. Let's work together so we can all return to a happier, safer, and more human world. Now I'm ready to begin. We are honored to have this morning a special guest, very special guest, Mr. Axel Christensen, Managing Director, Chief Investment Strategist for Latin America and Iberia at BlackRock. Thank you, Axel. Thank you for your support. Thank you for sharing with us all your experience. I would like to thank also to Greenberg Traurig for helping the Chamber to make possible this webinar. Before I pass the microphone to Antonio Peña, our president and shareholder of Greenberg Traurig, I need to mention the format of this conference. Antonio will give us an introduction of today's topic, and then Axel will make his presentation. At the end, we will have time for Q&A, so if you have questions, please send it to me through the chat, and we will try to cover as many questions as we can. So, Antonio, are you ready?
I'm ready.
Okay, so.
I want to say thank you to Axel as well. We're all living difficult times, but understanding what is happening and how we can find opportunities will be very important. And Axel, you're obviously extremely knowledgeable and an institution in the region, so we're eager to hear what you have to say. So thank you for being here. I think if someone would have told me a few years ago, let's say 15 years ago, that I would have lived through financial crisis like the ones we're living, I would have said no way. 2008, we all remember it well. Everyone compared it to the Great Depression. And yet, a few years later, we're living a very different type of crisis, but a very severe one as well. I think with respect to the United States, back in 2008, 2009, it reacted very quickly. It came up with a significant stimulus package of approximately $1.5 trillion. And maybe mid-2009, the economy started getting back up, started trending upwards and started getting better. So a lot of questions remain as to what are the differences or how can we react now in the midst of the coronavirus pandemic and the financial struggles we're living or that we're seeing. Yet I do think they're very different. I do think that, and I know actually you're gonna go deeper into this, but we remember 2008 as really primarily a financial shock, primarily caused by real estate and the balance sheets of the banks that then eventually started trickling down to the main economy. While here, as a result of this virus, the economy has felt the effects, the main economy, the day-to-day economy has felt the effects very quickly. And I also think that with the current pandemic, we don't really know when will things go back to normal. What's normal? There's still no vaccine. There's still no real effective treatment. The economies are opening up, or at least there's discussions about opening up different regions, different countries around the world. But how will people react? If there's no vaccine or no cure, are people going to still be living the way they used to live? Are they still going to get in elevators full of people? Are they going to go to concerts, restaurants? Do I really want to go to a restaurant? Would I rather eat at home? There'll be changes in the way we live till I think there's a solution, which as of today, there's still no quick answer. And those changes necessarily don't affect everyone the same way. You see differences in different industries as of today. Technology, for example, we're using technology in ways we probably weren't using it before. And we've seen opportunities and benefits to certain type of companies with certain type of technologies. Food or other type of remote manufacturing and distribution has kept active with respect to certain goods, but others not deemed essential or protective equipment, have in many instances just shut down. In certain industries like tourism and automotive and the airline industry are significantly suffering. And how will that change on a going forward basis? Those are a lot of the big questions that we have. Mexico has taken a more frugal approach. There's the discussions of approximately a $26 billion relief package by primarily focused on infrastructure and social spending. Will that be enough? Mexico has been hit hard as well, just because of oversupply of oil and very little demand, particularly now as a result of the pandemic. So a significant source of revenue for the country, oil, tourism, remittances from the United States, all that will change. And what does that mean for Mexico in the upcoming months? And then how does Mexico compare to the rest of Latin America? What's the rest of Latin America doing? So there's a lot of open items. Axel, thank you for being here. I guess I just laid out a lot of questions, and I don't know that all of them have answers, but if anyone can give us the rightful perspective, it's you. So thank you for being here, and I can see the work to you.
Thank you, Antonio. Thank you, Clementina, and thank you everyone for joining the call. Hopefully you're hearing me okay. So I just want to start by kind of setting up a little bit of how I want to conduct my intervention, and then hopefully I'm going to focus on 3 different points, and then open up the discussion for the questions that the audience might have. So my first remarks will cover kind of the global consequences and give kind of a broad picture. I will go somewhat deeper into the U.S. situation. Within that global context, we're going to touch upon kind of the pandemic and then the economic effects, and finally how financial markets have been also responding to the current situation. Then I'd like to kind of come down and do a double click on the region. So I will provide some insights towards how the region has been facing the pandemic, what to expect in terms of the economic impact, how we are seeing, again, the different markets react. And then finally, I'll dig a little bit deeper into Mexico and see how policy response, not only from the government, but the central bank, where the risks are, and actually where we see, longer-term opportunities for the region, including Mexico. And I must say that I'm fortunate to be presenting to you the collective work of the different units within BlackRock, or specifically the BlackRock Investment Institute, which I am part. And they've really done an excellent job in terms of conducting economic research market research, to connect with people that are experts on the health-related issues, to provide you this broad picture. So if I'm able to enlighten you with our views, it's just because I'm able to articulate this collective bring together of different ideas. I think Antonio put it right, that this crisis definitely has some elements that make it very distinctive to the more recent crisis. I think he was describing it in a way that, unlike the 2008-2009 crisis, which was pretty much a crisis that started in, let's say, Wall Street and eventually got caught by or transmitted into Main Street, this time around it's kind of the complete opposite. This is mainly a crisis. Not only is it coming from Main Street, meaning the real economy, even before that, this is definitely a health crisis, and we have to understand the roots of the crisis, among other things, to kind of identify the way we get out of it. But definitely, this was not incubated within excesses in the real estate market or bloated balance sheets in banks, as Antonio was making references to. If anything, the economy is being impacted by decisions to confront this health crisis. So to the extent that governments are choosing to enact lockdowns and other type of restrictive measures that impact consumption and production, this is what it's more of a consequence than an origin in itself. And this is important also to understand what things we can rely to in terms of instruments or answers that work in the prior crisis. We also should look into what history tells about other pandemic crises. And maybe start with kind of the good news. This is not the first epidemic that the world is confronted with. We've seen several since, I guess, mankind is present on the planet. We've been dealing with these micro enemies, which are the virus, and to the extent that if we look at, for instance, the most significant pandemic that we had at the beginning of the 20th century, this one which many call the Spanish flu, from the perspective of several years, if we look at the economic impact of this, very, very significant, and we're talking about millions of people, hundreds of millions of people being infected, and millions of people dying, numbers that are significantly higher than the current numbers that we have seen from the COVID-19. Again, with the perspective of time, at least the economic impact is much more limited. So the good news is, in terms of pandemics, there is a very significant short-term impact, and we're living it. There eventually will be some way of a health solution. It might be a vaccine. It might be a completely effective vaccine. It may be, partially effective, and eventually we will have successive waves, such as we have with the common flu or influenza now. Unfortunately, people do die, but the broader population kind of is able to kind of continue their life, and even before the COVID-19 pandemic, the whole crisis started, we went to restaurants, we boarded planes, knowing that there was a lot of different diseases out there, but we felt safe enough, and more importantly, we adapted to kind of being able to live with these health situation. So I'm fairly confident that we will get back to some expression of normalcy. Probably not exactly as our lives were before, And definitely that transition will be quite difficult because it will not affect every country or every activity or every industry in the same way. But definitely, if history is somewhat of a reference point, I'm very confident that the health crisis that we're confronting will eventually pass. And linked to that, the economic consequences as well. So actually, if you look at what the different focus of economic news has been, and probably more important as a sense of where thoughts are, we've actually seen somewhat of a rebound in some of a significant amount of financial assets. So, for instance, we saw the S&P 500 here in the U.S. Some other financial assets recover partially in different quantities regarding the lows that we saw more or less at the end of March. So that is telling us also that different market participants, different economic agents are really hard trying to look beyond. Now, are we getting too optimistic around this? Is it hard to not be pessimistic in relation to our own personal experience? In what I've been able to see just within BlackRock, it's been interesting to contrast in our global calls how the mood, how the emotional response to the current situation has been shifting. It was very, very gloomy at the beginning of this year within my colleagues that are based out of Asia, as they were the hotspot of the epidemic. And as things shifted towards the West, then my European colleagues started to be much more pessimistic. And at the same time, those people based out of Asia started to see, let's say in a way, like kind of the light at the end of the tunnel. So it's also important to understand that a lot of the projections and economic analysis is somewhat also influenced by what's affecting us personally and what the emotional linkage that we have, and definitely as the pandemic is shifting towards the Americas, to our continent, as we're probably experiencing closer impacts either personally or on people that we know, it's getting to closer degrees of contact, then it's definitely going to affect our way to look at this as well. But again, my attempt here today is trying to give you kind of a less emotionally charged picture and look at some of the data that we're able to put together. So definitely, this probably 2020 will be the year of the unprecedented. We've seen a series of unprecedented type of issues, starting with this has been probably the most global pandemic that we've seen. It's affecting the whole planet. It's almost completely synchronized. There's some kind of sequence. It started in Asia, as you might know, shifted towards Europe, and now the Americas is the focus. The U.S. just this last days completed over 1 million of infected cases. Reported cases, and the world has more than 3 million. And to that extent, it's also been accompanied of unprecedented economic consequences. So for instance, we're looking to a very, very steep fall in economic growth, a very big contraction in economic activity. And again, this is the logical response of governments taking the policy decisions of shutting down activity to as a way of finding an effective response to the pandemic. You've been, I guess, everyone's familiar with the term flattening the curve. The idea here of shutting down economic activity and having people not go to restaurants or not being able to travel is to contain the infections and not demand the ability of our hospital infrastructure to deal with the infectious cases that need treatment. And then again, we've seen already, different experiences, episodes in different countries on how important this is in terms of not getting into a situation where the death toll really increases to very high levels. So that is a decision has had a brutal economic impact. And then, unlike other crises that typically affected, partially or partial segments of the overall economy, like the 2009, real estate was really hard, and so was the financial system. But other activities, of course, there were the ripple effects of a global recession, but there was no direct impact of consumption in itself. So people continued to go to the supermarket to the extent that they were still had a job. They probably still went to a restaurant, maybe to they were spending less, but definitely there was no physical or health related restrictions, which is the case right now. And so if I look at, for instance, the IMF World Economic Outlook projections that they just published earlier this month, they've estimated that the global economy is going to take a hit of around 3% of GDP this year, and will show some rebound in 2021 that would kind of partially mitigate the deep recession that we see. And this is a view that is very much shared by our economic research team within BlackRock. We think that if you compare the accumulative effects of this recession, it might turning to be less damaging in aggregate than actually the last recessions. And this because of a couple of reasons. One, because the process of recovery, to the extent that there is not a lot of financial excesses out there, to the extent that governments are scrambling to provide necessarily support for companies to continue operations and to limit the amounts of bankruptcies and long-term unemployment. And we shall see how effective they are, but definitely they have been moving very, very quickly and in an amplitude in terms of the measures they've implemented. So looking at the U.S., for instance, and Antonio mentioned that the policy responses in the last crisis were fairly quick and strong. Well, this time around, they're quicker and stronger. So if the Fed took around 2 months to take interest rates to zero in the last crisis, it only took it 2 weeks this time around. They pretty much opened their balance sheet to unlimited acquisitions to ensure the correct functioning of financial markets. And definitely that has been the case. We've seen after a lot of stress of different markets that impacted liquidity and price formation, normalcy is gradually coming back. It has been more rapid in certain segments of markets, and it is taking more time in others, but definitely there's been a very quick response on the monetary policy side. And then if we look at the fiscal policy response, actually we have to go a lot earlier in time to look for an equivalent type of reference. We probably have to go to World War II, when the amount of fiscal impulse was at the same level that we currently are seeing. Several developed economies above 10% of GDP, even some economies above 15%, with the objective of really providing a bridge for companies, for households to kind of transition and avoid kind of falling into that valley, that deep valley that the economic downturn of the virus is triggering. So So in our belief, it will be a very, very steep recession, which probably will manifest itself with the strongest impact this second quarter and probably some of the third quarter. But we believe that it should be shorter in terms of recovery in aggregate, and I'm going to come back to that in a second, as we are seeing a stronger response on the policy side broadly. And then second, we do not have some of the significant misbalances that were really strong obstacles for the economy to recover going into the prior crisis in 2009. So the excessive leverage that we were seeing in households that were very exposed to the real estate market is at a fraction today. Banks, among other things, as a consequence of increased regulation, that was a response from the prior crisis, are also in a lot better shape. If anything, corporations, non-financial corporations, are probably the weakest link, and that's where a lot of the efforts of supports are going in terms of not avoiding bankruptcies on the one hand that could contaminate into a financial crisis on the bank side, but more importantly, to secure longer term. So governments are stepping in, trying to allow companies to offload some of the costs of maintaining employees on payroll to when economic activity is able to open up again. So in the case of the U.S., the IMF is calling for a correction of about 6%. These are year-over-year numbers. This week we'll have the preliminary first quarter numbers for the U.S. and as a way of how numbers are presented, we should expect a fairly big number. These are typically quarter-over-quarter numbers that are annualized. But again, the brunt of the bad numbers are probably going to start showing up in terms of economic growth in the second quarter. We're already getting a sense of how deep the recession is on the unemployment front, as we're seeing, again, unprecedented levels of unemployment benefit submittals. These are already above 22 million. And definitely they are showing that, the nature of this Main Street rather than Wall Street type of crisis. So that's basically the setting. Our view is that the U.S. economy is at the forefront of those economies that have a better chance in a faster recovery. If we also include emerging economies, China, for instance, is already showing signs of recovery. But again, it's also an excellent example of how the recovery, although in aggregate might look good, is also hiding very different realities. In China, for instance, industrial production is very close to coming back to where it was before the epidemic took hold, but consumption is taking a lot more time. And again, I want to stress that there's been a very strong emotional impact of this crisis on all of us. And as Antonio was pointing out, it's going to take us a while for us to feel comfortable to perhaps go to a restaurant, to go to a sports event, or jump on a plane, unless it's something that is essentially needed either for family or for business purposes. So on the consumption side, we're already seeing signs that the pace of recovery is going to be different. But in other sectors, not only it is showing to be much faster than initially thought, but in some sectors, and Antonio mentioned technology, I would probably add everything related to healthcare services. We not only will see a recovery, but actually are expecting an increase of activity. And at the same time, other industries that, because of their nature, are more impacted. So the hospitality, the tourism-related businesses are definitely going to take longer. And in addition to that, some industries that already were having a negative impact of disruptions, changing business models. So for instance, think about commercial real estate, shopping centers that were losing, market shares to e-commerce. If anything, the pandemic has accelerated these disruptive trends. Or think about something that is going to, be important for Mexico, but to the extent that we've started to see, an increasing pace of shifts from fossil fuels to renewable energy sources. What we're seeing that the pandemic is probably accelerating that process, and the collapse of oil price is not only a signal of a fall in demand, of course it is, but also perspectives that the recovery will probably not be complete, and that disruption that was already occurring has accelerated. So let me finish kind of the first topic I wanted to mention. It's going to be a steep recession, but markets and our own calculations are looking towards a faster recovery than what we saw in the past crisis at least. And this is because of the strength and quickness of the policy response, but also of the nature of the crisis itself. So to the extent that we will have probably an emergency vaccine as soon, and a more globally massively accessible vaccine towards the next year. But more importantly, as these decisions of lockdowns and our own responses of changing our behavior, this will certainly allow us to start this uncomfortable transition process in which we will kind of dabble with this concept of new normalcy. And again, some things will probably revert to something very close to what they were beforehand of this crisis, and others probably will change more permanently. It's very hard to be precise on those predictions today, but we definitely think that's going to be the case. So let me look into our region for a while. Definitely, this crisis is not coming at the best timing for Latin America. Many of our countries in the regions were already struggling with low growth, with low prices for their main exports, with political and social unrest. And so it is no surprise that if we look at different regions in the world, at least from the IMF, and this is also consistent with our own research, we are projecting that it will take longer for Latin America to recover. That recovery, as I mentioned, on the global scale, will be uneven as well. Some countries, because they took measures faster and are dealing in terms of the economic consequences with a stronger response than others, to the extent that certain economies are more exposed to industries that have a longer-term impact from the COVID-19 crisis. We definitely should expect a very, very dispersed trajectory of economic recovery as well. So if we look at the region, the IMF is estimating that the region will probably have an economic downturn of slightly above 5% for the year. And again, these numbers are probably tilted to be revised on the downside, as we still see the pandemic still growing in numbers in the region in certain areas. The hardest hit economies in terms of the predictions are, of course, Venezuela with an expected 15% downturn. And then among the larger economies, we actually have Mexico with a contraction between 6 to 7%. I'll come back to why this is hitting Mexico perhaps harder than other countries. Then Brazil pretty much around the average at 5.3, and then several other countries, they all have contraction estimates, but at a more moderate level, let's put it, quote unquote. So Peru and Chile probably see their economies decrease between 4 and 5% this year, and then Colombia is somewhat less affected, between 2 and 3% correction. And then for 2021, there is kind of a partial bounce back on the extent, to a certain extent, supported by recovery of economic activity and a boost from a global reactivation as well. In this sense, to the extent that China has been recovering faster, is also an element that provides some differentiation among the regions. Those countries that are more exposed to more China intensive commodities such as industrial metals like copper, or agricultural projects such as soybeans, might have a quicker bounce back than those that, for instance, are more exposed to oil. Now, the markets in the regions have significantly, reacted to this more negative, forecast, and we can, see this in different dimensions. Probably the financial asset or market that has been more sensitive to a bleaker outlook for the region is the currency. So we've seen, currencies devalue year to date only to the extent of more than 30% in the case of Brazil, almost 20% currency devaluation in the case of Mexico, and then Peru is at the other extreme with the Peruvian sol only losing about 14% year to date. So definitely currencies have taken a very big hit, among other things because a lot of governments have seen that the policy response in terms of where they want to take the impact has been on the currency side rather than trying to maintain rates high. If anything, most central banks have been very responsive to reduce rates to the extent that their inflation levels allow. So we've seen central banks reduce rates from 100 basis points in certain cases to more than that. Peru, again, stands out. They've cut rates 200 basis points and actually have left them at 25 basis points above zero. That makes them the country with the lowest monetary policy rate, very, very close to Chile with 0.5%. And then again, Mexico has been a bit more, reluctant in terms of the pace. The Banco de Mexico, the central bank, has recently cut rates 100 basis points, but they're still at 600 basis points, 6% above zero, and makes them among the countries that are not in a crisis, such as Argentina or Venezuela, at the highest level compared to 375 for Brazil and Colombia. So definitely markets are responding. Stock markets have also corrected substantially. Again, Brazil almost 33% year to date. Colombia not very far back from that. Somewhat less so Mexico, Chile, and Peru. But investors have been very, very hesitant in terms of keeping exposure to a region where not only are we seeing, in certain cases, a delayed response to the pandemic crisis, but a much more limited response in terms of policy initiatives to support economic reactivation going forward, or even support to allow unemployment not to go up too much, or bankruptcies to go through the roof. So we've seen definitely Latin America reflect the concern on how long it will take and what the longer term impact it will be. So let me end with some remarks around Mexico. I kind of hinted that Mexico has been hit and the forecast that we're seeing from different sources, such as the IMF, but also shared by private investment banks, all point towards probably Mexico having within or among the larger economies in Latin America a much stronger impact of the pandemic. And there's 2 or 3 reasons behind this. One is probably an important one is that the initial starting point for Mexico was weaker than the rest of the countries in the region. Mexico was already in a mild recession ending 2019. Rates were also standing out as fairly high in the region. It has, the Mexican Central Bank has been behind the rate cut cycles that we've seen other central banks in the region adopt more aggressively, namely in Brazil, for instance. So that also has meant that real rates in Mexico were higher going into the credit crisis. We believe that as inflation is going down significantly, there will be more space, but definitely the starting point is one of the issues that makes Mexico one of the more negative cases within the region. Then second, I also mentioned, and Antonio also did comment to the extent that Mexico is more exposed to industries that are taking a larger hit because of the pandemic. So, of course, tourism as an important source of services, especially in specific regions within Mexico, specifically towards the southeast. Then, of course, the oil prices, which is definitely a double whammy because of, on the one hand, we saw a collapse of demand because of the shutdowns, the economic shutdowns. But to aggravate things, we also saw a very, very nasty response in terms of supply with Saudi Arabia and Russia pretty much, triggering a price war that brought prices even lower. And then kind of the cherry on top has been this whole issue regarding how futures have been evolving. And we saw, like last week, this again, unprecedented anomaly of negative future prices affecting the markets, at least for a while. So that is also having an impact, although not as important as it was in the past on the overall configuration of the sectors in the Mexican economy. But as many of you know, very, very important in terms of sources of revenue for the government. And increasingly, as we've seen in the recent past, as a way of transmitting an increased risk to public finances, to the extent that the Mexican government had been kind of stepping in to provide financial support to Pemex, given its very difficult situation, lower oil prices, very high cost production levels, loss of market share. All these things have made the oil situation, more significantly important than just looking at the economic, impact as a sector. Now, and on top of that, the manufacturing sector that is also being impacted by the shutdowns of the U.S. factories for instance, in the car industry is also going to have a substantially more important impact vis-a-vis other economies that are less connected to the U.S. manufacturing in the region. So a confluence of sector-related type of impacts is also adding to a more negative outcome or projected outcome for Mexico. And finally, I would probably also add to a mix of policy decisions. On the one hand, Mexico took somewhat longer to take more strict containment measures of restricting mobility and asking people to stay at home. Even with a shift in the last weeks, it's still less strict than some of the responses we've seen in countries like like Peru or Argentina. And then probably more importantly, we're still observing a high degree of hesitance in terms of the government of really committing the level of resources from a budget perspective. I've mentioned that the U.S. and European countries have already expressed their intention to commit levels that are 10% and above of GDP. In the region, we've also seen at least announcements that also, to the extent possible, because Latin American countries have a lot less muscle and financial capabilities to mimic what the U.S. and Europe are doing. But we've seen Peru with announcements in the neighborhood of 10% of GDP, Chile between 6 and 7%. We have Brazil in around 3.5 to 4%, and then Mexico is their announcements up to now are barely above 1.5% of GDP. There's been a lot of friction in terms of how the private sector has been looking for financial support to withstand the collapse in the economy, with the government that has been very, very, strong in their sense of keeping the fiscal balance in place. And this, of course, to the detriment of not applying more resources to protect jobs or to protect, economic activity going forward. Now, I guess that is in lieu of not shutting down the economy completely. We'll have to see if that alternative ends up working well. As I mentioned before, in the region, we have several different type of responses. Some are pointing to the possibility of economic reactivation starting earlier, as we're starting to see, for instance, in Colombia and eventually in Chile. Some are taking more time. Some actually countries have been even more permissive than Mexico, and namely Brazil. But this has also triggered increase of political instability, as we've recently seen in terms of changes in the cabinet and some friction between the federal and the state governments in Brazil. So our outlook for Mexico is very cautious on the short term. In relation to this, we've seen already credit rating agencies downgrade Mexico's sovereign rating towards only one notch above the investment grade threshold. And as I mentioned before, Pemex has actually lost its investment grade, with all the consequences this has in terms of their cost of funding going forward. So very cautious on the short term. But I want to end, before opening up the call for your questions, with a remark that we are actually more positive on the medium term, to the extent that Mexico gets back on track. It might take longer than anticipated. Actually, Mexico stands to benefit from what we think will be one of the consequences of the pandemic, which is somewhat of a descaling of the globalization that we have been seeing in the last decades, in which companies will look for an increased diversification in their manufacturing process. So the whole concept of having global production change will probably shift towards diversified regional production chains. So some of the production that have been outsourced to Asia, there's what we believe in the medium term, there's a good chance that might come back to the region, and Mexico actually has a good set of capabilities in terms of the industry acumen that they have, and the electronics and the car business, to benefit from that restructuring of global production. But that will take a while, and in the meantime, I think we want to be cautious in terms of how things develop going forward. So let me hand back the microphone to you Antonio, to see if, or I'm sorry, Clementina, to see if we have questions from the audience.
Yes, I sent it to you. And can you listen? Yeah.
I'll take them right away. Okay, I got them. Yes, a lot of questions. So do you want to start with anyone in particular? So I guess the first question you sent me, Clementina, is very interesting because we're seeing that I mentioned a lot of these countries in the developed world are adding up, 10, 15% of GDP in stimulus. Now, how are they funding this? It's primarily debt, right? Because, if anything, the economic activity and hence their revenue capabilities are coming down. So many countries will issue debt, the US, Europe, and Latin America is probably not going to be an exception. Now, I guess most people that I've been, able to address are kind of very coincidental in the answer in terms of let's focus on getting out of the crisis, even if this means increasing our debt load, and then we'll take care of that, issues going on forward. And that's kind of concerning, right? So again, I mentioned in the beginning, history does allow us to look at certain references. Although it is true, I think that what is it, Mark Twain's quote that history does not repeat itself, but it rhymes. We could take that phrase and look at what has happened in the past. So, I mentioned the Second World War was also a situation where governments incurred huge amounts of debt to not only finance the war, but to reconstruct afterwards. And to a great extent, as a consequence of those heavy debt loads, it took a while. It wasn't immediate, but it took a while. We did see a significant increase in inflation. So one way, unfortunately in Latin America, we know this movie all so much. One way that governments deal with, overhangs of debt levels is to, liquefy that debt load, meaning higher inflation over time. So definitely that is something that we're concerned about. In the short term, probably inflation will continue to be low as we're seeing on the one hand the collapse of demand and also the impact of these disruptive factors such as technology and other phenomena that are impacting fuel prices or retail prices. But eventually we should look and consider inflation as a longer term risk and as a way of how in the past governments have dealt with balance sheets that are too high to service. It seems, at least for the short to medium term, the other responses that do not involve inflation, meaning fiscal austerity programs, which we've tried in the region, again with very, very mixed type of results, they seem harder to envision in the shorter term, as if anything, as part of the responses to the epidemic. We will probably see an increase in terms of government support to those sectors and households and workers that are having a harder time, returning to normalcy or getting a job or opening up their businesses again. So definitely, inflation, unfortunately, is one of the ways that we will have to deal with this in the future. Questions about the permanent effect on how people do businesses in the future and consumer behavior. It's going to be interesting. Definitely, I do subscribe to the saying that old habits die hard. It is very difficult to change behaviors, even with such significant events and situations as we are currently living. I think that many things will probably revert to some things similar to what we've seen in the past. Some things will change more permanently, of course. I think, for instance, that what I mentioned before, the degree of redundancy that companies will have to incorporate in their production processes will be something more permanent. The use of technology to increase efficiencies in terms of reducing travel expenses, or just to make our interactions more efficient. Again, some things were actually probably in the process of changing anyway. So the more permanent change is probably more ascribed to more structural trends, and that the pandemic accelerated, but was not created by the pandemic itself. So I mentioned the changes on how we shop, and probably people will stick with a larger proportion of e-commerce related purchases rather than going to a shopping center. The way that probably where I'm more skeptical about is probably not going to restaurants and eating home. I guess to the extent that we will probably see a transition, the way we probably approach restaurants will be different. I do believe that in many cities where being a restaurateur was already a challenge because of increases of rent and personnel expenses, the concept of restaurant as a business model will probably be revisited. But definitely, this is a personal perspective. If I had to kind of evaluate what things will I be willing to change more than others, I would probably see myself traveling less and having more interactions like this with people in the region. Perhaps buying more, on electronic platforms and going to a mall. But I don't envision if anything, I want to go out and spend more time with friends that I have not been able to see, or family. And I guess going to a restaurant is a big component of social meeting again. So definitely, I think that in certain industries, of course, there will be a financial impact, but the behavior itself, I don't see them changing as much. Let me see some other questions. Before that, Clementina, I know that we're kind of already on the time. Should we end now, or should we allocate some additional time to answer some of the questions?
Yes, we are. It's 12 o'clock already, so maybe one more about the USMCA. What do you think? That one, and then unfortunately we need to say bye and then track the.
Sure. So I'll answer that one briefly. Definitely, the USMCA is one of the few positive issues in a very challenging environment that I think I went into certain detail. Of course, we're going to miss probably the boom of this happening in different circumstances. I would have said, and I actually said this before, going into 2020, one of the benefits that Mexico had, despite that 2019 was a challenging year in terms of economic growth, was the fact that in a world where trade was very it was under very challenging situations, when we saw that between the U.S. and China, to the extent that Mexico had the USMCA under its arm was definitely kind of a very strong competitive advantage. It still is, but probably we're not going to see its whole power, showing in the short term, to the extent that we're going to probably be more impacted by all these other factors I mentioned before. But I want to mention it continues to be an advantage that Mexico has, and hopefully it will also be an accelerator to materialize those longer-term benefits that I've mentioned, of that Mexico stands out to be a beneficiary of a world in which we will probably see more regional trade groups, more integration at the regional scale, and less so globally because of either geopolitical issues or some of the risks that we were able to identify during this pandemic. So unfortunately, USMCA not with the strength that we might have expected, but definitely on the positive elements, looking at Mexico and its economy. Hopefully, the more challenging aspects are confronted and we're able to leave them behind fastly, and we get to a better place sooner than later. So with that, let me end my remarks and thank you again for the opportunity of presenting to you today. Hopefully, these remarks were helpful, and I look forward to a future connection in the future. Thank you so much.
Thank you, Axel. Thank you. We hope all you enjoyed this webinar as much as we did. We will keep you informed about our next webinar and future initiatives through our social media. And this Thursday, our chapter in New York will present a video conference about essential sectors in the US and Mexico, disruption on supply chain, trade, and industry reaction. So we will send the details later today. And here for you, if you need me, please contact me. And there is something that we can do for you or for your business, we are here. Take care and stay safe. Bye. Thank you.